For the longest time, the path to building wealth felt pretty straightforward. Stocks and bonds, right? But what if that's not the whole story anymore? Today, we're going to dive into the world of alternative investments and figure out why they're suddenly such a big part of the conversation.
In this question, this really gets right to the heart of it. That classic 60-40 portfolio, 60% stocks, 40% bonds, has had a tough go of it lately. It's making a lot of people wonder, is it really enough to build a portfolio that can handle the ups and downs of today's markets? Let's see if there's a missing piece to this puzzle.
So to answer that, we first need to get a handle on what we're even talking about. So what exactly are alternative investments?
Well, it's actually pretty simple. They're basically any investment that falls outside of those usual buckets. So think of it like this. You're expanding your financial toolkit beyond the standard stuff, stocks, bonds, mutual funds, that most of us already know.
And this category is incredibly broad. We're talking about things like private equity, which means you get to own a piece of a company before it hits the stock market. Or private credit, where you're kind of acting like the bank, lending money directly to companies. And then there are the tangible assets, things you can literally see and touch, like real estate, or huge infrastructure projects like bridges and airports, and even commodities like gold or oil.
Of course, anytime you step into new territory, you've got to understand the whole picture, the potential upsides and the potential downsides. So let's break down the all-important benefits and risks.
And here it is, the core trade-off. On one side, you get this really powerful diversification. See, these assets often don't move in the same direction as the stock market, which can be a great stabilizer for your portfolio. But, and this is a big but, on the other side you have limited liquidity. We'll get into exactly what that means in a second.
Another huge draw is the shot at higher returns by getting in on the ground floor of some really exciting modern sectors. I mean, just think about the insane amount of money pouring into things like AI-driven data centers or new sustainable energy projects. Alternatives can give you a ticket to those opportunities long before they ever hit the public markets.
Okay, let's circle back to that key risk I mentioned, liquidity. This is absolutely critical to understand. Unlike a stock you can sell with a click of a button, many of these investments require you to lock up your money. For years, you can't just decide you want your cash back tomorrow. It doesn't work that way.
Now for what I think is the most exciting part of this story. For decades, this whole world was basically walled off. It was only for giant institutions or the super wealthy. But that is changing, and it's changing fast. The door is finally starting to open for the rest of us.
This timeline really says it all. What used to be an exclusive club with like million-dollar minimums is now becoming so much more accessible. We're right in the middle of this shift, where the price of admission is dropping and the products themselves are getting way more flexible for individual investors.
So you're probably asking, how is this happening? Well, it's really a mix of a few key things. First, we're seeing these really smart new fund structures, like interval funds. They're designed to give you a chance to get your money out periodically, maybe once a quarter. That adds some much-needed flexibility. You pair that with existing regulations, and that's what's helping to bring those entry points way down, from millions of dollars to the tens of thousands.
Okay, so the door is opening, which leads to the obvious next question. If this sounds interesting, how in the world do you actually get started?
Well, the advice from the experts is pretty consistent. Start small. Think about carving out a pretty modest slice of your portfolio, somewhere in that 5 to 10% range. This lets you dip your toe in the water, see how things go, without, betting the farm.
So, have a look at this. This probably looks pretty familiar to a lot of you. It's that classic 60-40 split between stocks and bonds. It's been the go-to for a long time, but like we said, it might not be as diversified as it used to be.
But now, check this out. By just shifting a small piece of the pie over to alternatives, you've basically added a third engine to your portfolio. It's not some crazy overhaul, but now that 10% slice is working differently from your stocks and bonds, and that can help smooth out the ride over the long run.
Let's make this feel a little more real. Picture a professional, maybe in her 50s, starting to think more seriously about retirement. Her portfolio has done well, but it's pretty heavy in tech stocks, and she's feeling every single market swing. So she decides to put a slice into an interval fund that focuses on private credit and infrastructure. Over time, that part of her portfolio can start generating steady income from loan payments and long-term contracts, acting like a ballast to steady the ship when the stock market gets choppy.
All right, as we start to wrap this up, it is so important to have the right perspective here. This is all about enhancement, not a total replacement.
And this quote just nails it. Alternatives are not some magic pill. They're not a replacement for your core stock and bond holdings. They are a complement. and they're best for investors who really understand and are okay with the trade-offs, especially that lack of immediate liquidity. So, at the end of the day, who is this really for? It's for the patient investor. If you have a long-term mindset and you're looking to build a stronger, more robust portfolio that goes beyond the basics, then this is definitely something worth looking into.
Which leaves us with one final question for you to think about. In a world where markets are always changing, could the right kind of alternative be that missing piece you've been looking for to complete your own financial puzzle? It's definitely a question worth exploring. Thanks for tuning in.